Let's start with the primary levels and our call resistance level. The call resistance level is the price level with the most net gamma when it comes to calls. Generally, this is the level with the most upward resistance. Let's take the MenthorQ net gamma exposure chart to better understand why this level can become a reaction zone. The call resistance level is the strike price with the highest net call gamma. This is represented by the wider green bar. This also means that this is the level where there is the most call open interest and call gamma. Investors have been buying out of the money call options at that strike price. But why does it become a resistance level? If we think about market mechanics, we know that the market maker is going long to hedge against the investor call options. As the spot price moves closer to the core resistance levels, those calls that were previously out of the money start moving into the money. At that point, investors that were long out of the money call options start closing those positions. And the reason is obvious. If you're long an out of the money call option, you want to monetize it when it moves into the money, whether you're a hedger or a speculator. That is the main reason why the core resistance becomes a resistance. As investors close those call options, market makers will also adjust their delta hedges. Remember, market makers were going long to hedge those calls. Once those calls have been closed, the market makers has to close their long exposure, and this stops the market from moving above this level. Now, can the spot price break above this level? It can indeed, but it requires a further catalyst. Let's take the example of GameStop in 2020, when investors were buying calls, forcing the market makers to continue to go long to remain delta hedge. That was a bullish force on the market that kept forcing the market higher. So how can we use this level in our trading? Similar to how you would use a resistance in technical analysis, our core resistance can be used in the same way, but it encompasses the power of options data. We can use this level as a resistance or reaction zones where the price slows down its uptrend and can bounce to the downside. If you are in a long trade, you can use this level as a profit target area, and if you're looking for a reversal trade, this can be an efficient level of entry. The core resistance can also be an inflection point for an acceleration to the upside, similar to the GameStop example. If there is a bullish sentiment in the market, a break above the core resistance level can bring upside momentum. Let's look at this chart. This is the chart of Nvidia at the end of March 2024. We are in a strong uptrend, and on March 26, the price is approaching the $1,000 mark. Here we see the net GEX or net gamma exposure chart from our models, and we can identify two key levels, the core resistance and the core resistance 0 DTE, which looks at the market positioning at the next weekly expiration. The 1000 level and the 950 level are the one with the highest exposure. As we can see from the chart, the price reaches this level and then retracts, if fails to break above.